And we're going to look at assessing the profitability. So we're going to take a look at the income statement and balance sheet to analyze profitability. So we're going to look at net sales to assets, rate earned on assets, rate earned on equity, rate earned on common stockholders' equity, and earnings per share on common stock. So we're going to get into each of these individually. And the price earnings ratio. And dividends per share. So net sales to assets, this is how effectively a firm utilizes its assets. So you have all these assets, but you acquire assets to make money, to sell stuff. So how effective does a firm use its assets to make sales? That's what we figure out here. So if we have to calculate our average total assets. So if we look at 2012, we take our total assets at the beginning of the year plus our total assets at the end of the year. We get 2,097,500. Divide that by 2, we get our average assets, 1,048,750. So now if we take our net sales, 1,498,000, divided by our average total assets, we get a 1.4 ratio of net sales to assets. So that means that they have $1.40 of sales for every dollar of assets. And you look at it, it's an improvement over 2011. So they're utilizing their assets better in 2012 because they're earning $1.40 of sales for every dollar in assets versus $1.20 in sales for every dollar in assets in 2011. And for our average total assets, it's important to exclude long-term investments. So now we're going to look at rate earned on total assets. So we're going to look at the profitability of the total assets, but we're not going to consider how they're financed. So we're going to add back interest expense to our net income. So first we're going to take our net income, $91,000 in 2012. We're going to add back interest expense. So we're going to get $97,000. Then we have to calculate our average assets again. So we take our beginning assets plus ending assets divided by 2, and we get 1,185,000 is our average total assets. So if we want to calculate our rate, we'll take our $97,000, which is our income plus interest expense, divided by our average total assets, and we get 8.2%. So we're earning 8.2% on our assets versus 7.3% in 2011. So we got better year over year. So now we're going to look at rate earned on stockholders' equity. So we're going to look at the income earned based by the stockholder investment. So how much are we earning from this investment of the stockholders? So we're going to take our net income, which was $91,000 in 2012. Then we're going to calculate our average stockholders' equity by taking beginning stockholders' equity plus ending stockholders' equity divided by 2. So if we divide our net income, $91,000, divided by average stockholders' equity, we get 11.3% earned on stockholders' equity, which is an improvement over 10% in 2011. So for when stockholders invest money in the company, we're earning 11% on that money stockholders are investing in 2012. So let's look at leverage. So if we look at our rate earned on total assets, so if we look at the first bar, 2012 of 8.2, and then the rate earned on stockholders' equity, which is 11.3, that difference of 3.1 is called leverage. Which if you look at 2011, our leverage was only 2.7%. So now we'll look at the rate earned on common stockholders' equity. So this is the rate we earn on investments by common stockholders. So we're going to again take our net income, and then we're going to look at our stockholders' equity, but we're going to look at common stockholders' equity. So our common stockholders' equity beginning plus ending year gets us 1,617,000 divided by 2 gets us our average stockholders' equity. So if we take our $91,000 net income divided by our average stockholders' equity of $808,500, we get an 11.3% average earned on common stockholders' equity. So earnings per share on common stock, this is a real popular one if you look at the Wall Street Journal or Yahoo Finance. So it's the income earned for each share of common stock. So to calculate this one, we're going to take our net income less preferred dividends. So our net income, $91,000, 2012, less preferred dividends of $9,000 gets us $82,000 for the numerator. If we have 50,000 shares of common stock outstanding, we take $82,000 divided by 50,000, it'll get us $1.64 earnings per share on common stock, which is an improvement over 2011. Another one that's pretty big, and if you look at Wall Street Journal or Yahoo Finance, is the price-earnings ratio. It indicates, supposedly supposed to indicate the firm's future earnings prospects. So to calculate this, we're going to take the market price per share of common stock, which would be what you see in the Wall Street Journal. That would be the market price, over the annual earnings per share like we calculated on the previous slide. So in 2012, we take $41 price per share divided by $1.64 earnings per share, and our price earnings ratio is 25. What that means is that when you buy the stock in the market, you're paying 25 times more than the earnings on that share. So earnings on that share that you're getting is $1.64. You're paying $41 for that $1.64 of earnings. Therefore, you're paying 25 times earnings for that share of stock. So dividends per share and earnings per share. So if we look at 2012, our dividends per share was 80 cents a share. Our earnings per share was $1.64. And if we look at 2011, they both go down a little bit. Dividends per share would be the dividends we declare first divided by shares of common stock outstanding. So dividends per share. So what happened if we look at 2011, our earnings per share went up, and as a result, we increased our dividend per share. Which means that's a common occurrence, because when you have more earnings to distribute, you can distribute more of them through the dividend. So dividend yield, this is the rate of return to common shareholders in terms of cash dividends. So to calculate our dividend yield, we're going to take our dividends per share of common stock, which we calculated on the previous slide, divided by the market price per share of common stock. So dividends per share, 80 cents. Market price in the Wall Street Journal, 41 bucks. So our dividend yield on common stock is 2%. So per share, this stock pays 2% of dividends per share based on market price. So you buy the stock for $41, you're going to get 2% annually in dividends, which is a number you typically want to see be a little bit higher. So if you look at 2011, the dividend yield's a little bit higher. So 2011 to some might be a little bit more attractive if you're looking to get the dividends. But 2012, the market price of the stock went up. So if you buy the stock with the intention of gaining dividends, you might be a little better off in 2011. But if you're gaining the stock for the market price to get higher to sell it, you might be better in 2012 because the stock went up 14 bucks a share from 2011.